The cell is formatted to display as 0. You are staring at a number that is not supposed to exist. It is 11:48 p.m. in Oslo. The office is empty. The harbor is black through the glass. The model was supposed to hold. You have run this exact stress test 53 times on this exact fixed income sleeve. Tonight is number 54. Tonight, at 11:48, the model breaks. The error is not yours. A senior portfolio manager named Erickson overrode a duration constraint 3 weeks ago. He buried it inside a single cell on a tab nobody checks, formatted the output to display as 0. 380 million kroner notional, leveraged exposure to long-dated Norwegian government bonds. The swaps assumed flat volatility in perpetuity. The hedge ratio looked correct on the surface. Underneath, it was decorative, completely non-functional, a fiction held together by formatting. You work at a regional asset management firm in Oslo. The firm manages 4.2 billion kroner. Nobody outside this building has heard your name. You are 27 years old. You have been running quantitative risk for 14 months. Tonight, you find what Erickson hid. Then, Norges Bank releases a surprise monetary policy statement, an aggressive rate hiking path. Nobody expected it until March. The mark-to-market loss hits 61 million kroner in the first hour, and it is still moving. You do not sleep. You do not call your manager. You do not call Erickson. You open a blank spreadsheet and build a second model from scratch. Different assumptions, different structure, same inputs. The second model confirms the first. You build a third. All three converge on the same number. The exposure is real. The loss is real. The concealment was deliberate. At 2:15 a.m., you compose an encrypted message to your compliance officer. You attach every cell reference, every timestamp, every override log. You include a sentence that says, "This was not an error." You press send before you can talk yourself out of it. The message goes. By 7 a.m., compliance has escalated directly to the board. The building shifts. You feel it in the air before you see it in the faces. By noon, external auditors are sitting in the fourth-floor conference room requesting files that nobody had prepared. Erickson is placed on administrative leave before lunch. Nobody on the trading floor makes eye contact for the rest of the week. The silence is structural. Everyone knows. Nobody speaks. The position unwinds at 43 million kroner loss, not 61. The market moved in your direction overnight, but what they remember is not the number. What they remember is that you found it. You built 3 models. You sent the message at 2:15 a.m., when you could have waited until morning, when you could have let someone else discover it, when you could have preserved your relationship with a senior manager and let the loss surface on its own timeline. You did not wait. 3 weeks pass. Erickson is terminated. His desk is reassigned to a junior trader who does not know what happened there. You return to your routines. The spreadsheets return to normal. The models hold. The days resume their ordinary shape. Then your phone rings. The man on the line is named Håvard Vestergaard. He has never worked anywhere small. He works for Norges Bank Investment Management, NBIM, the entity responsible for managing the Government Pension Fund Global, the Norwegian Sovereign Wealth Fund. You know the numbers. Everyone in Norwegian finance knows the numbers. $1.4 trillion under management. It owns approximately 1.5% of every publicly listed company on Earth, over 8,700 companies in 73 countries. The fund is larger than the entire gross domestic product of Spain, larger than Australia, larger than Mexico. It is the single largest owner in the world's stock markets. It holds 25% of London's Regent Street in partnership with the Crown Estate. It owns hundreds of buildings in the most expensive cities on the planet. It holds stakes in renewable energy infrastructure across Europe and North America. It is governed by the Norwegian Ministry of Finance and accountable to the Storting, the Norwegian parliament. It was created from oil revenues. It invests only abroad, so the Norwegian economy does not overheat. Every Norwegian citizen has an implied stake of over $340,000. Havard tells you there is an opening in quantitative risk. He tells it the way someone tells you the weather. He tells you to think about it over the weekend. That tells you everything. If you are watching this right now and you have never heard of the Norwegian Sovereign Wealth Fund, stay here. By the end of this video, you will understand power in a way that most people never will. Subscribe now because what comes next changes how you see money forever. You start on a Monday in January. New building, Bankplassen 2, Oslo. The headquarters of Norges Bank Investment Management sits inside the historic Central Bank complex in the Quadraturum district, 200 meters from the harbor. The building was first opened in 1906, originally for 80 employees. It now houses the operations center of the largest pool of public capital ever assembled. New badge, new floor, different numbers entirely. Your badge reads Analyst Quantitative Risk. For 8 months, you are precisely that. You build factor models. You decompose portfolio variance across the fund's 4 asset classes. Equities at roughly 70% of total value, fixed income at about 27%, unlisted real estate at up to 7%, and unlisted renewable energy infrastructure at up to 2%. You run correlation analyses across currencies, sectors, countries. You never touch the controls. You are not invited to touch the controls. $800 million decisions are made in the tone as choosing where to eat lunch. The number doesn't feel real. 800 million still sounds like someone else's problem, someone else's responsibility. What changes you first is not the size, it's the patience. This fund absorbs. It does not react to quarterly earnings misses. It does not react to credit rating adjustments or geopolitical headlines or the panic cycles that move every other pool of capital on Earth. It holds. The fund is so large that if it panic sold, the selling itself would crash the market it was trying to exit. So panic was not suppressed, it was removed, structurally eliminated from the operating framework. You learn what genuine capital permanence looks like, not as theory, not as a concept from a graduate program, as a lived, daily, operational condition. The fund was established in 1990. Its first investment was made in 1998. It passed $1 trillion in 2017. It passed $1.7 trillion in 2024, overtaking Japan's government pension investment fund to become the largest asset owner on Earth. Since inception, the average annual return has been 6.64%. More than half of the fund's current value is return on investments, not oil money deposited by the government. The capital grew itself. The machine built itself.
Markets open, markets close. Crises flare across continents and fade into footnotes. The fund does not blink. It was not built to blink. It was built to outlive every crisis and every person inside this building. 8 months in, you are still a function. You process, you model, you report. But something in how you see money has permanently shifted. The scale has entered your nervous system. You cannot think in millions anymore. That unit no longer works. It is like trying to measure the ocean in teaspoons. You learn slowly, then all at once, the way you always learn what matters. By year 3, the title changes. So does everything else. You are in the room when allocations are decided, not at the table, not yet, near the wall with a notebook, while the people who control $1.4 trillion discuss rebalancing the way other people discuss lunch orders. You are invisible, and you are absorbing everything. This is where you learn that nothing works the way the textbooks described. Nothing works the way they taught you at NHH, Norwegian School of Economics. The decisions are political, relational, archaeological. Every number in this room has a relationship behind it. Every relationship has a history. Every history has a failure embedded somewhere that only 2 or 3 people in the room remember. Institutional memory is the real currency here, not models, not data, memory. The head of equity allocation is a woman named Silje Lund. She controls equity investments spanning approximately $1.2 trillion across more than 7,200 companies worldwide. She operates through a form of intellectual rigor so precise and so relentless that it functions as a kind of structural force. It is not aggression, it is architecture. She has a willingness to make people above her uncomfortable that is not courage in the way most people understand courage. It is simply how she is built. It is how she operates the way a turbine operates, without apology, without hesitation, without the faintest interest in whether the room finds her likable. You watch her kill a $2.1 billion infrastructure allocation in 40 seconds. 40 seconds. The allocation had been in preparation for 3 months. She looks at the counterparty model. She identifies the consulting firm that built it, the same firm whose methodology had been implicated in the collapse of a Dutch pension fund in 2019. She remembered. Nobody else in the room remembered. She did not look it up. She did not check a file. She carried it the way other people carry their own phone number, effortlessly, permanently. The room goes silent. Nobody argues. The allocation dies in 40 seconds and is never resurrected. Her memory is not a skill. It is a weapon maintained with the discipline other people apply to physical fitness. You decide to build your own. You start an archive. Every deal, every consultant, every risk model, every counterparty, every assumption, indexed, cross-referenced, 3 notebooks in 3 months. You record the things nobody asked you to record, the things the institution forgot, the things that only survive in context, in the space between formal reports, in the hallway conversations that never get documented, in the footnotes that nobody reads twice. After 6 months in that room, you are a fundamentally different analyst. You cross-reference 7 years of internal fund records against external counterparty databases and public filings. You find patterns nobody had cataloged, exposures that had drifted from tactical positions into structural holdings without anyone formally acknowledging the shift, names that had quietly disappeared from watch lists, correlations that had decayed without being retested. The archive grows. The pattern becomes clear. The institution has a memory problem. You are becoming its memory. Then, one afternoon, Silje asks you a question, directly, in front of the full room, 14 people. The question concerns a correlation assumption embedded in a Nordic credit sleeve that was last reviewed in 2018. Nobody in the room remembers the assumption. Nobody remembers why it was set where it was set. You answer from memory, from the archive, from notes nobody asked you to take. The room is silent for 4 seconds. Silje nods once, returns to her papers. In this room, at this level, in this institution, one nod from Silje Lund is everything. It is more than a promotion. It is more than a title. It is admission into a trust structure that operates entirely without documentation. You are seen now. The table you are not yet sitting at feels closer. You remember everything after that. The fund, the names, the failures, the models, the relationships. All yours. Filed, indexed, permanent. You keep the memory the institution cannot keep itself. Most channels will never tell you this story. Most channels do not know it exists. If this is the kind of content you want to see more of, hit subscribe. We are building something different here at Diana Invest. Year 5. Portfolio Strategist. Real assets. You are no longer watching the table. You are at the table. The real asset sleeve you now oversee is valued at approximately $74 billion. Infrastructure, real estate, timberland, unlisted equity, renewable energy infrastructure.
The fund owns 25% of Regent Street in London through its partnership with the Crown Estate, a deal first struck in 2011 for £448 million, the fund's very first direct property investment. It owns hundreds of buildings across major cities in Europe, North America, and Asia. It holds stakes in wind farms and solar installations from the Netherlands to North America. These are not trades in any conventional sense. You are acquiring structural positions in the physical world, positions measured in decades, not quarters, positions that affect water supplies, energy grids, shipping routes, and the daily lives of millions of people who will never know the fund exists. You take a significant equity position in a Chilean desalination consortium in the Antofagasta region, water infrastructure for an area where rainfall has declined steadily for 15 years. You negotiate a ground lease on a logistics complex in the port of Rotterdam, duration measured in generations. You become a cornerstone investor in a Kenyan renewable energy developer. The position will represent a material share of Kenyan's national electricity generation capacity within the decade. You expected to feel powerful. Instead, you feel implicated. That word is new, implicated. Power at this scale does not feel like power. It feels like a permanent obligation that arrived without a contract and cannot be returned. You did not sign up for obligation. You signed up for quantitative risk. The obligation found you anyway. On a Sunday morning in June, the Chilean Desalination Consortium raises water prices by 22%. The following Tuesday, an NGO publishes a 94-page report. The report connects the price increase directly to foreign institutional ownership. It names the fund. It does not name you. Nobody will ever name you. You are invisible at both ends. Invisible to the people in Antofagasta who cannot afford water, invisible to the people in Oslo who set the mandate. You exist in the space between, where the actual decisions live. You read every word of the report, every footnote, every data table, every photograph. Back at Bank Plassen 2, you model the reputational risk, then the regulatory risk, then the political risk, then the replacement cost. The replacement cost of exiting the Chilean position entirely is $2.3 billion. That is the number that decides, not the report, not the photographs, not the families who cannot afford the increase. The number decides. It always decides. You recommend a $14 million community investment program, desalination access subsidies for low-income households, structured as a long-term commitment with local governance oversight. The fund approves it within the week. It is not idealism. It is risk management with a human face attached for structural reasons. You are uncertain which framing is more honest. You sit with that uncertainty for a long time. It does not resolve. It will never resolve. The ideology you arrived with, the clean categories of right and wrong, the belief that good intentions produce good outcomes, all of it has been replaced by calibration. Quieter, more durable, less comfortable, more honest about what honesty actually costs at this altitude. Every position you hold affects someone. Most of them will never know your name. You manage $74 billion with the same discipline you applied to 4.2 billion kroner at a regional desk in Oslo. The scale changed. The fundamental question did not change. What is the real risk here? Not the modeled risk, not the reported risk, not the risk that fits neatly into a variance decomposition. The real risk, the one that lives in the space between the spreadsheet and the world. Year 5 closes. You are at the table. You are also inside every system you touch. You are beginning to understand that those are not the same thing. Year 8. The call does not come from inside the fund. It comes from the Ministry of Finance. Akersgata 40, Oslo, 12 minutes on foot from Bank Plassen 2, a completely different universe. Minister Solberg offers you the position of Deputy Chief Investment Officer. She says it like a question. It is not a question. You accept, knowing that sleep will never be fully restored. That is also not a question. The CIO is a man named Thorvald Eriksson. He has held this chair for 9 years. He is one of 3 or 4 human beings on the planet who have managed sovereign capital at this scale for this long and survived the experience with their judgment intact. You study him the way you once studied spreadsheets: patterns, tolerances, blind spots, decision latency. You measure how long it takes him to act, what makes him pause, what makes him accelerate, what he ignores, what he pretends to ignore but files silently for later. Capital at this scale does not move through markets. It moves through relationships. That is the first lesson at this altitude. The second lesson is that the first lesson cannot be taught in any classroom or program. It can only be absorbed through years of proximity to decisions that reshape economies. You sit across from a global bank CFO in the NBIM London office, Queensberry House, 3 Old Burlington Street. You are restructuring $90 billion in Tier 1 capital requirements. You extract board observer rights, full fee transparency, the most aggressive ESG covenant ever inserted into an institutional banking partnership at this scale. The fund follows an ethical mandate set by the Storting. It cannot invest in companies that produce nuclear weapons. It cannot invest in tobacco manufacturers. It cannot invest in cluster munitions producers. It has excluded companies for environmental damage, human rights violations, and corruption. It divested from coal companies exceeding production thresholds. The ethical framework is not decoration. It is operational. It shapes every deal you touch. The bank's stock rises 4% on anchor investor rumors before a single word is spoken publicly. The information moved before you did. It always does at this level. You do not control information at this altitude. You manage the consequences of its movement. You oversee the $1.4 trillion liquidity framework. Every assumption, every correlation, every scenario. Thorvald makes decisions you cannot yet fully follow, decisions that seem to skip steps, decisions that arrive before the analysis is complete, as though the analysis is merely confirmation of something he already understood through a channel you cannot access yet. You filed those decisions. You will understand them later. You always understand later. Sleep becomes a managed resource. You schedule it the way you schedule currency hedges, 11:30 p.m. to 5:15 a.m. on weeknights, not negotiable, not flexible, managed. Your personal calls decrease from 11 per week to 3. Your marriage compresses to logistics, shared calendars, coordinated school pickups, weekend silences that are not hostile but are not warm either. You notice, she notices. Neither of you names it. At this level, personal cost is not accidental. It is structural. It was built into the role the way load-bearing walls are built into a building. You cannot remove it without collapsing the structure. You accepted it implicitly the day you answered Havard Vestergaard's phone call years ago. You just didn't know it yet. You sign a $2.2 billion allocation in 5 minutes. A billion, now a unit of measure, no different than a kilogram or a kilometer. The scale has stopped feeling abstract. That is the most dangerous transition of all. When a billion stops feeling like a billion, you have either mastered the instrument or lost all contact with what the instrument does to the world. You are not certain which. You may never be certain. Then Thorvald tells you something he has never said to anyone in this building. He gives 18 months' notice, privately, to you alone. Nobody outside this floor will know for 6 months. The external candidates list is long, distinguished, international. You watch it get crossed out name by name over the following months. Some withdraw, some are withdrawn. The list shrinks quietly, the way lists do when the real decision has already been made somewhere else. The confirmation arrives in a 4-minute call from Minister Solberg. 4 minutes. No ceremony, no congratulations, a transfer of permanent obligation disguised as a brief telephone conversation. You are now Chief Investment Officer of the Government Pension Fund Global. You control more capital than the gross domestic product of most nations on Earth. The fund returned 13% in 2024, 2,511 kroner, a record. You are 41 years old. There are 12 missed calls on your personal phone. Pause for a moment. If this story has changed how you think about power and money and what it actually costs, subscribe to Diana Invest. Share this with someone who needs to hear it. This is the content we make here. This is what we do. Power does not arrive as freedom. It arrives as a narrowing. Every conference you attend is parsed globally. Every letter you publish is analyzed by sovereign funds, central banks, hedge funds, and government ministries on every continent. Every vote you cast at an annual general meeting of a portfolio company is scrutinized. The fund votes at over 8,000 shareholder meetings per year, over 90,000 individual resolutions. Every vote is public. Every vote is permanent. Your name is attached to each one.
You stop attending conferences. The signal you send by not appearing becomes its own signal. Markets interpret your absence the same way they interpret your presence. There is no neutral position. There never was. You learn to distinguish deliberation from paralysis. They feel identical from the inside. The only difference is the outcome. One produces a decision, the other produces the appearance of a decision. At this level, the appearance is often sufficient. That is a truth you did not expect. The people who can speak to you freely now number fewer than 20. That number will shrink. It will keep shrinking for as long as you sit in this chair. The network that carried you here contracts the moment you arrive. Same process that built it, different direction. Your marriage is now a logistics operation. You both understand the terms. Neither of you renegotiates. There is nothing to renegotiate. The structure is the structure. You chose it, or it chose you. The distinction stopped mattering years ago. CIO, Year 2. A G20 economy enters a sovereign debt crisis, illiquid but not insolvent. That distinction is everything. The market does not see the distinction. The market has priced default. Credit default swap spreads have tripled in 6 weeks. The IMF stabilization package is 12 weeks from formal approval. 12 weeks is a geological age in sovereign debt markets. Countries can collapse in 12 weeks. Currencies can be destroyed in 12 weeks. Governments can fall. You have $18 billion in dry powder, a strategic rebalancing that Thorvald endorsed reluctantly in his final months. $18 billion undeployed. The capital sat in cash equivalents for 6 months. Nobody was comfortable with it. The opportunity cost was discussed in every allocation meeting. Thorvald held firm. You understand why now. He saw something coming that nobody else saw. Or perhaps he simply understood that undeployed capital is the only capital that matters in a crisis. Every other dollar is already committed. Only dry powder gives you options. You run the scenario for 4 days, 96 hours. Your team builds models around the clock. Every model says the same thing. The country's debt is serviceable under any reasonable restructuring assumption. The fiscal position is strained but recoverable. The problem is liquidity, not solvency. The market has conflated the two. That conflation, that failure to distinguish between a country that cannot pay and a country that cannot pay right now, is worth $6.2 billion. You deploy across 11 trading days, 3 tranches, 2.1 billion, 2.4 billion, 1.7 billion. Sovereign bonds of a country the market has already written off. You deploy quietly. No press conference, no signal, no coordination with other sovereign funds or institutional investors. You do not call anyone. You do not brief any government. Not enough capital to rescue a country, enough to signal that permanent capital, the most patient capital on the planet, sees value where the market sees catastrophe. Other institutional investors follow within weeks. They do not call you either. They do not need to. The position said everything. At this level, the position always says everything. The IMF package finalizes on better terms than projected. The country does not default. Sovereign bond yields reverse. The position marks to market at plus $1.1 billion unrealized. 14 months later, the gain is still growing.
quietly, permanently on the books of a fund that does not celebrate. No public statement, no press release, no interview. Acknowledging what you did would require acknowledging what you moved. What you moved is not supposed to be movable by a single institution. The mandatory annual disclosure filing triggers a legal review by the Ministry Council. Expected. Handled. Within mandate. Technically. That word, technically, does all the structural work. The parliamentary review by the Storting is classified as structural, not punitive. The question is not whether you violated the rules, the question is whether the rules are still adequate for what the fund has become, whether the mandate, written for a smaller fund in a simpler time, can contain what this institution now has the power to do. The legal opinion arrives on a Tuesday evening. You read it at your desk at Bank Placin 2. Parliamentary review, structural, not personal. But you understand what happened. You demonstrated what was possible within the mandate. By demonstrating it, you made the mandate change. The next CIO will operate inside a narrower framework. You showed where the edge was. By touching it, by proving it existed, you made it permanently smaller. You expanded the fund's demonstrated capability and contracted its future operational freedom in a single action. The institution absorbed your success and restructured itself so that your success can never be repeated by your successor. That is the reckoning. That is the system trap. The system does not punish you for succeeding. It incorporates your success into its own immune response. It learns from you the way it learns from everything, slowly, structurally, irreversibly. Year 2 closes. The position holds. The review opens. The rules begin to change around you like weather that you caused but cannot control. You set down the legal opinion. Markets open in Tokyo in 4 hours, Singapore in 5, London in 8, New York in 13. The world does not pause for parliamentary opinions or structural reviews or the private reckonings of a 43-year-old Norwegian sitting alone in an office at Bank Placin 2 on a Tuesday night. $1.4 trillion, over 8,700 companies across 73 countries, 1,389 properties, renewable energy infrastructure spanning 2 continents. Every single one of them opens tomorrow. The liquidity framework assumes that no single event will require simultaneous liquidation across all 4 asset classes. That assumption has held since the fund's first investment in 1998, 26 years. You are not certain it holds forever. Nobody is. Nobody can be. The fund's own stress tests have modeled a fragmented world scenario, a breakdown in global trade, aggressive tariffs, restrictions on foreign investment that could erase more than a third of the fund's value, 37%, trillions of kroner, gone, in a scenario that, as of this year, no longer feels entirely hypothetical. The quant team flags a correlation breakdown in the real asset sleeve. Something in the variance decomposition does not resolve cleanly, a pattern in the data that should not be there, a signal where there should be noise. The pattern reminds you of something. A spreadsheet. Oslo, 11:48 p.m. A regional desk. A smaller life. A cell formatted to display as 0. The scale changed everything. The numbers changed, the addresses changed, the titles changed, the weight changed. But the fundamental question did not change. It was there at 4.2 billion kroner, and it is here at $1.4 trillion. What is the real risk? Not the modeled risk, not the reported risk, not the risk that fits neatly into a variance decomposition or a quarterly presentation or a parliamentary filing. The real risk, the one that hides in formatting, the one that lives in assumptions so old nobody remembers who made them or why. You open a new analysis window. You start building a model, the way you always have, the way you always will. Somewhere below you in this building, a junior analyst is running a stress test that will not resolve until morning. You do not know her name. She does not know you exist in any meaningful way. She is sitting where you sat. She is looking at what you once looked at. She is asking the question you once asked. She found something at 11:48 p.m. that does not hold. The fund was here before either of you arrived. It will be here long after both of you leave. The capital is permanent. The people are not. That rule has never changed. It never will. The correlation flag is still open. The model is incomplete. The analysis will not resolve until morning. Somewhere in the world right now, a crisis is already forming that neither of you will see coming. Somewhere inside this building, another operator is already rising. Same trajectory, same process, same trap. You are powerful, but you are not safe. You are never safe. The chair does not make you permanent. It makes you visible. Those have never been the same thing. The parliamentary review opens in 3 weeks. The rules will be rewritten. Your successor will inherit a narrower mandate. The system absorbed what you showed it and closed the gap behind you. That is what systems do. That is what this system has always done. That is the trap. The game does not end. Every resolution opens the next problem. Every answer reveals the next question. Always, without exception, without mercy, without any regard for what it cost you to arrive at this desk, in this chair, at this hour, in this building, that was here before you were born and will be here after your name is forgotten. Tomorrow the markets open, indifferent to everything you have built, patient as geology, waiting to show you what you still do not know. Tomorrow you sit back down, and you begin again. The fund is real. The system is real. The trap is real. If you made it to the end of this video, you are not a casual viewer. You are the audience we built this channel for. Subscribe to Diane Invest. Turn on notifications. The next story is already being written. You do not want to miss what comes next.